LVMH or Nike. I'm say Bernard Arnault or Phil Knight.
Yeah.
What should I spend my time on?
Merchandise, 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 merchandise,
Hmm.
merchandise. Right. First things first.
What's a diffusion brand?
A diffusion brand is, let's say, so you've Michael Kors, which is
Yeah,
the preeminent brand, the luxury premium brand, and
sure.
then MK Michael Kors or MK Kors or Kors Michael Kors. I get them all confused. Whatever brand does not just say Michael Kors, but has like an extra initial or
Right.
letter in it, that's a diffusion brand. It's usually distributed at a more mass price point and more mass outlets. So it's essentially how many gross margin dollars are you getting for every dollar you spend on inventory? How profitable and how much utility are you getting from your inventory? It has to be greater than one.
Hello, Mariah. It's great to finally have you on the podcast. Thank you for coming on.
Hi, Shreya. I'm really happy to be here.
So, Mariah, I think let's just get to how you got started. In your most recent role, you were the CEO of ELOQUII, which is a plus size fashion brand for women. And in your past roles, you've been actively involved in, several fashion brands and companies. So, what really got you interested in fashion?
My grandmother. So my mother is a real tomboy, but her mother took great pride and interest in what she was wearing and how she was put together. And she dressed a lot like Katharine Hepburn. Like she called them slacks. She didn't call them
Wow.
pants. And I pretty much worshiped her. And when I was given the opportunity in middle school to write a paper, I chose Coco Chanel for no reason other
Wow.
than I think my grandmother did not wear Chanel, but I was generally inspired. Turns out Chanel also wore a lot of pants. Coco Chanel did, and I think that was the genesis of it.
That's pretty exciting.
I
Yeah.
think one of the things that really resonated with me is that my grandmother would be, in the afternoon would have had some tea or been out gardening, or she was a painter, and she would be a bit sort of like, have dirt or paint on her or something. And she would go up to her bedroom and change for dinner, and she would come down and she would hold herself differently. She would be sort of moving differently. And that was, I think, as a young kid, it was I was impressionable, and the impression it made was fashion can transform you. What you
Yeah.
wear actually can make a difference in the way you hold yourself, the way you think about yourself, the way you speak, etc.
So what was ELOQUII? And when you were thinking about joining it, and then you have an interesting story as to why and how you joined ELOQUII, and then how did it transform over the years?
Yeah, so Eloqui is not your quote unquote typical startup in many ways, in the sense that although we did raise a bunch of venture capital and we did sort of start at zero, Eloqui had already existed under the Limited being the mall-based brand that was started by Les Wexner back in the day. And the Limited in around 2011 started to notice that they were losing customers who had sized out of their core offering. They
Hmm.
were best known at the time for like suits, like they were a knockoff of Theory suits. And so they were losing customers who had either lapsed out of the top or the bottom size. And the Limited, I think, quite intelligently said, why don't we create a sister brand that will help capture and retain these customers whose sizes are changing? So
Hmm.
that was Eloqui. So the original logo lockup was Eloqui by the Limited.
Yeah.
Uh, and the Limited, as many large corporations do or larger companies do when they're thinking about incubating or launching something, they way overplanned it. I
Yeah.
think the plan was that they were going to do $25 million in the first year. That's a lot of inventory to buy. And, unless you're going to spend a tremendous amount of marketing to build a brand out of nothing, it's hard to do that kind of revenue
Right.
in day one in sort of like, let's call it non-commodity apparel. And so the Limited then a year later shut it down. And it was essentially an asset on the CFO's desk, right? It was a
Hmm.
buyer file and intellectual property. And our former chairman that, bought those papers, those ultimately, like in hindsight, very valuable papers from the CFO. So it was an asset purchase.
Right.
Um, Several of the original team members who had worked on ELOQUII under the limited came on board. I joined a couple of weeks after the asset purchase had closed, and off to the races we went. That was the fall of 2013. And so what we had was a list of buyers who had bought ELOQUII when it was under the limited. And we were in a race against time to
Yeah.
get the business set up again, because the longer you have a buyer file that's getting cold, the less valuable it becomes.
Hmm.
So it was a mad dash to design new merchandise, set up a new supply chain, build a new site, all new 3PL, all new marketing. I mean, we really kept very new fit, kept very, very little
Yeah.
from what the limited had done. And in a way that was both a headwind and a tailwind for us.
Why did you think that your experience was critical for the company to grow, going forward?
Oh, I didn't. Let's be
Okay.
clear. I was not qualified. Right? Like, what happens when you've never been a CEO before, right? Like, at some point, you're just going to be a CEO and you're going to have to do it for the first time. I was really compelled by the opportunity for both, personal reasons and market data. Like, I, at that point in time, had started to see in different magazines, because that was back when we actually still like read physical magazines.
Yeah.
It was on the decline, but it was still happening. I would see magazines devoting a page to this customer
Hmm.
where they had never done that before.
Yeah.
And that had piqued my interest before I'd even heard of ELOQUII as an opportunity.
Yeah.
Uh, and then on the personal side, uh, oh, I should add that when I started to learn about ELOQUII and I started to do some research, I was very, very compelled by the fact that this is 70% of women, or at the time it was 67% of women over the age of 18 in the United States. And that I couldn't believe we weren't talking about this customer all the time. Whereas in fashion, that customer is really never spoken about. So that was sort of the market and professional insights that made me quite interested. On a personal note, I had family members who fit the customer criteria. And as a kid growing up, I thought they wore the same thing every day because that was their choice. I didn't realize that they wore the same thing every day or a version of the same uniform every day because they didn't have choices, right?
Right.
Did not have options the way that someone who is a smaller size has a panoply of options at every price point across multiple types of distribution. So that was this real like, oh, I've been an idiot. I've been blind. Now I see, and I feel compelled to do this. Was I qualified? No, no. Like it was, I really learned on the job. Hopefully I learned quick enough to, you know, to do it somewhat effectively.
Absolutely. And that's a lovely story. And I like the fact that you mentioned that people learn on the job. And, one of the episodes that we did with Jen Berry, she is, former Bridgewater Associates, and now she's running her own platform for startup companies. She mentioned that one of the ways that Bridgewater hires is to really look for skills the last, but look at values and integrity of a person
Mhm.
before they look at skills and the capabilities, general capabilities, because if you have the basic minimum, then the hope is that you will learn and you will learn fast. So,
I love that. I love
yeah,
that we didn't start off that way, but at Eloqui we developed into a culture that had very strong core values.
yeah,
And my bias, unless it was a very specific sort of technical role where we
yeah,
needed a certain type of experience, my bias was generally to hire the smartest person we could find who embodied the core values to the best of our ability to understand.
yeah. So, Mariah, I think what is very interesting about your journey is that you've led two exits, one of Send the Trend to QVC, where you were the co-founder, and then the other of Eloqui to Walmart, where you were the CEO.
Mhm.
So, what was common and different across these two exits?
So I think one thing that is in common, the main thing is luck, right? And I don't want to deflect and say, oh, it was just luck and these things happen. But I think anyone who's been through an exit, especially in a D2C business, there's a lot of luck and just good timing involved. And so that's sort of like the commonality. I would also say the other commonality is that with both exits, it wasn't the mantra of like, when is a good time to take a profit? It's always a good time to take a profit. We
Hmm.
were not in either case going to wait and say, well, let's see if we can raise more money and then push the valuation further and then push the hurdle higher. Because every time you raise more money at a higher valuation, you're crowding out your profitable exit opportunities. And so
Hmm.
sometimes, right, like the more money you raise, the last
Yeah.
investor that comes in, depending on, I mean, if it's private equity, they're going to want a 3x. If it's growth equity, they're going to want a 3 to 5. If it's venture, they're going to want a 7 to 10. And so, I mean, those are approximate, but so that means that if you were at $100 million valuation and then all of a sudden you go to a $200 million valuation, that means you need to sell the business at a $600 million
Yeah.
uh, value. There aren't that many businesses that can spend that kind of money.
Yeah.
So while it can seem better to have a higher value, and then sometimes it really is, especially if you're going the route of a really successful IPO or you're going to
Right.
have a private equity transaction. If you're thinking about a strategic acquisition, I think you need to be thoughtful about who the likely buyers are and how big their balance sheets are.
Hmm.
So I think that was a commonality across both. Other than that, they were really different. Then the trend was really acquired for its technology. It wasn't an acqui-hire, like all the investors made money and everything, but we had built, or our director of technology
Yeah.
had built a very a before its time recommendation engine on Hadoop and Mahout. And this was something that QVC was interested in more than they were interested in the actual send the trend consumer business, which I'll just say was not really, customers didn't really love our business.
Yeah.
And which was quite the opposite with ELOQUII. ELOQUII customers loved our business. Like we had a
Yeah.
very high NPS score by and large for most of our, we had a couple of dips, but by and large, our NPS was above 75.
Oh, wow. Okay.
Yeah, there was a moment we cracked 80, and I was like, we have hit Nirvana. And that's not always an indicator of how much they're going to spend with you, but I think it
Right.
is an indicator of how vested they are as
Yeah.
customer bases. And so when Walmart bought ELOQUII, it was really about brand. It was about the merchandise, the type of merchandise we were designing and producing, and its fit. And it was about customer insights. They
Hmm.
could not have cared less about our technology, right?
Yeah.
Like that was not a differentiating factor at all. But everything that you could see as a customer, the look and the feel of the marketing, the look and feel of the merchandise, and the language we used, and sort of the thinking behind how we touched the customer at every touch point was what they were interested in.
I love that. And then you started off as a consumer co-founder, right? I believe your focus wasn't on technology when it comes to Send the Trend.
Yeah, that just happened to be what we got bought for.
Yeah. So then how did you sort of change your mind or rather train your mind, right? Because if you were getting acquisition offers with regards to your technology and you're a consumer co-founder, how do you behave? Like, is it easy, or were you still hell bent that no, I want to build a consumer company?
No,
Not
because the idea with QVC wasn't that they were going to immediately dismantle our business.
yeah.
We'd get to continue to grow it under QVC, and
Ah,
QVC would leverage the technology that we had built for some of the other parts of their businesses.
yeah.
So from an M&A transactional perspective, it's quite similar.
Hmm.
And Walmart, in a different way, did something akin to that, which was they said, Eloqui, we're going to let you continue. We want you to continue,
Yeah.
or eloqui.com, business, your stores, et cetera. But we also want you to build a business for us.
Hmm.
So we built a diffusion brand for Walmart that was at a cheaper price point, a slightly more accessible aesthetic. So right, both times it was a both and.
Right. What's a diffusion brand?
A diffusion brand is, let's say, so you have Michael Kors, which is
Yeah,
the preeminent brand, the luxury premium brand, and
sure.
then MK Michael Kors or MK Kors or Kors Michael Kors. I get them all confused. Whatever brand does not just say Michael Kors, but has like an extra initial or letter
Right.
in it, that's a diffusion brand. It's usually distributed at a more mass price point and more mass outlets.
Is Armani Exchange like a diffusion
Yes,
brand of Giorgio Armani? I was
exactly.
literally explaining this to my husband. I just didn't know that diffusion brand is a term.
So Boss, Hugo Boss,
Yeah. Yeah.
diffusion brand.
Interesting.
There are Ralph Lauren is the king of figuring out how to do this
Ah,
and really make the diffusion brands themselves huge and substantial, and allow the for Ralph Lauren Purple, right, the really
yeah.
premium one, to exist. That brand probably doesn't even need to be profitable. I would
Right.
imagine they're making so much money on the other brands and the licenses that that's sort of their loss leader. I don't know
And
that for
I'm
I'm just surmising.
and I'm guessing that the way the customer or rather the consumer is changing, there is also a possibility that the diffusion brand actually ends up getting more revenue versus the
Almost always.
Oh, wow. Okay.
Almost always, right? Because it's cheaper.
Right. Yeah.
When it's cheaper, you can do. So there are going to be exceptions, but if you look at a business like Vera Wang, she is known for incredibly gorgeous bridal.
Right.
Where did she really make her money? On her mattresses and her fragrance and et cetera, et cetera, et cetera. So those are examples. I would put licenses and diffusion brands into the
Right.
same bucket.
So for folks who are listening to the podcast and, you know, the founders who are contemplating exits, when is the right time to think about an exit and what are the variables that one should take into consideration while planning an exit? Is there a plan that needs to exist at all or just, you know, acquirers or private equity players just approach you?
Oh, if only. Um, so I would say that, I mean, I'm going to be a contrarian here. I think there are there's a lot of smart money that will say you should put your head down and just build a great business. And when it's time to have a conversation about an exit, then you will, right? And if you've done your work and you built a great business, then just as you said, the private equity or the strategics or the market will open. I actually think you should think about it on day zero.
Hmm.
With send the trend, if nothing less than as a hedge, as a
Yeah.
risk mitigation strategy.
Yeah.
With send the trend before we even launched the business, we on a whiteboard, my co-founder and I wrote down the range that e-commerce businesses were trading for in this was 2010, 'cause I'm so old. We wrote down that range of X million to X million. This is the trading range, and these are the top 10 businesses that would ever be likely to buy us. We sold for the middle of that range to one of the businesses that we had written down.
Oh, wow. I love that.
So it was quite, we were just being thoughtful about what is realistic and where should we be building relationships. At ELOQUII, we had inbound interest pretty much out of the gate. We had a lot of random inbounds on LinkedIn, cold inbounds. One of the like the rules was if you get a random LinkedIn inbound, like just send it to Mariah. Like it's just even if it seems weird, just send it to Mariah. And so I said, yeah, I'll meet with you. Yeah, I'll travel to X location and X location and go and meet with the chief merchant or the head of business development, even though we're only right now a $10 million business and we
Right.
have no interest in selling right now because I want to build a relationship. I know that you're going to try to pump me for information. I know that I can control for that. But I think more than anything else, what I wanted to understand what and be able to go back to the team and sort of think about was why do you think we're valuable? Why do you want to have this lunch that we're having? And
Right.
what do you want to know? And every single time, without fail, it was we love the brand you're building. We think that your merchandise, like they were all trying to copy it. We could see it. We could see the orders coming in like $2,000 orders coming in from assistant merchants at XYZ places because they were going to try to copy our fit. So they would say to us directly, like, we love your merchandise. We love the brand. We love the photography. We love the fit. The way that you're speaking to the customer is new and novel. We're in the business of making clothing, but we can't figure it out like the way that you're figuring it out.
Yeah.
What that said to me was, don't go back and invest in engineers. Go back and invest in the brand and the merchandise,
Yeah.
the marketing and the merchandise all day long. That's where the value accretion is going to happen for ELOQUII. So that's, I think you should be doing that all the way through. You should be completely opportunistic. I also don't think it's a dumb idea to meet with bankers. I think, again, I'm a contrarian here. 30 minutes with a banker, as especially if it's around the time that you might be raising capital or thinking about an exit, they are a wealth of information. You don't
Yeah.
have to give them a lot of information. They trade in information. You might get a really good sense about what a competitor's raise just looked like that you might
Yeah.
not be able to get from someone else. Um, and in terms of when to exit, I think sometimes you don't have a choice, but I also think it goes back to what I said before, which is that it's always a good time to take a profit, especially in D2C consumer. I the market was hard in 2018 when we sold. It's harder now. And so I think there are a few really unicorn examples, but the thing is there's always a few unicorn examples.
Exactly.
Majority are not unicorns, but there's still money to be made.
Do you think consumer founders or CEOs are more empathetic human beings?
I don't know. I think that's an interesting question. I think perhaps they're more extroverted human beings.
Right.
I am not. I am like more of an introvert. So, um, but I think there's a curiosity about sort of value creation in the world of physical goods and services. So it feels quite practical, right? Because we are all consumers.
Yeah.
Um, and I appreciate that, right? I appreciate thinking about things from that lens. Whereas if you're selling, B2B software, it can feel like detached and
Mm,
just a few bits removed. And I like feeling the closeness with the customer. I find it motivating. I also think consumer is one of the reasons it's so hard. I
yeah.
mean, everything in this sort of
Everything.
world is pretty hard. So I'm just going to speak about my hard is that the consumer is so incredibly dynamic,
Right.
as has supply chain has become incredibly dynamic, and I think will become more and more commoditized in certain ways, and in other ways, you have to be incredibly strategic about how you're allocating your assets across your supply and your resources across supply chain because it's a place where you can really compete and win. Yeah, but I think that the dynamism makes it very, very hard to know what the day is going to hold.
Actually, coming back to exits, one thing that doesn't get talked about a lot is just how the transition happens for the company that gets acquired into the larger company. In your case, ELOQUII got bought by Walmart. And so, what were your biggest learnings as you were trying to integrate yourself and your team into Walmart?
So I think that for founders and CEOs who are on the journey to an exit, I heard from investors, like investors who are friends who had invested in the business, like, oh, once you sell, gravy. That's not true. That is that is not true. It's a different kind of hard,
Right.
but it's hard. I found it to be hard, and challenging in ways that were helpful and I learned, and in other ways, maybe maybe not so much. Um, I think that the difference in the hard is that by and large, when you become part of a large organization, certainly Walmart, which is I think still the largest company in the world, although don't quote me on that. Uh, you know, I wasn't worrying about cash flow anymore.
Right.
Like that's a beautiful thing.
Yeah.
to not be thinking about your next fundraise. But I was not used to a hierarchical, I had not been in a hierarchical organization or had a boss who I had to report to 2 to 3 times a week for for a really, really, really long time. And so that was different. And I think if you are an achiever and a performer, then you're going to take it as seriously as anything else you've ever taken seriously in your life. Um, and I think that there's also, you've gone from small company, in it to win it, David versus Goliath type of culture that is very like special and small to very different type of culture where there's a lot more resources and there's different opportunities, but you really have to, we had to do a lot of listening and a lot of work to help both our customers and our associates understand that just because we have been bought and by Walmart, it wasn't a bad thing. In fact, it could be a very, very good thing.
Right.
And that just took time, right? There was like no silver bullet for that. It was a lot of listening sessions and a lot of surveys and focus groups and transparency and time. So there can be this culture clash. And I think by making a few mistakes, I got a good lesson and maybe you can't rush that.
What was it like personally for you in the sense that, you just mentioned that you have always been a performer and an achiever. Um, and, when you are in a startup environment, you kind of control a lot of things. And, there is a higher likelihood that you're able to have a large impact. It doesn't necessarily have to, really speak to scale immediately. Like it can be like a 10 million revenue as opposed to 100 million, um, versus Walmart will have, or a big company will have a larger revenue. But what does it do you really think that, having more control is important for an achiever, versus going to a large company? And what were you feeling actually?
It was an adjustment period. It was an adjustment period. So I think that when you're by and large, unless I think this would be a great exception, your people, your HR function and your finance function are going to be functionalized, right?
Right.
So the our head of HR and our head of finance, instead of reporting to me, started to have a dotted line to me and reported into executives at Walmart. And so that's weird
Yeah.
when all of a sudden you no longer control the resources of the business. The resources of any business are its people and its capital. While most of the time, I would say all of the time Walmart had good intent, and most of the time they were really good partners, it's a weird thing to no longer have a say and to be able
Hmm.
to move fast and to do things
Yeah.
that oftentimes are quite simple, like
Yeah.
hiring or firing
Yeah.
a, a person.
Yeah.
When you have to get permission and wait and wait, I could think, this is not serving my business. I understand how this is important for the greater good of Walmart, but that's in conflict what I think is for the immediate and greater good of ELOQUII. And so getting comfortable with less control is, um, it was an interesting growth opportunity. And I think I discovered that I quite enjoy control. Like control's my thing.
I'm realizing that about myself as well. The other thing that I'm realizing is that, speed is very important to me, which could be both a good thing or a bad thing, because then I'm not sure how to balance my patience with my intended level of speed. And so I don't know how you think about it, because, I'm in this phase where I am hell bent on a particular outcome, which again may or may not be a great thing. But how do you think about that?
There's that African proverb. It's like if you want to go fast, you go alone. If you want to go together, you go slow or something. That is, I completely just butchered it, but that is,
Yeah.
and that was said to me multiple times in the version of kind feedback that
Yeah.
Mariah, you go too fast. The harsher anonymous feedback was you go too bleeping fast. We feel left out. Like, um, so I, in especially pre-Walmart, the idea of move fast and break bleep, right? That expression, like I lived for it. I wanted to go as fast as possible. Um, and I really was not thoughtful. I was not thoughtful about the fact that other people, my colleagues, didn't have all the same information that I had. And they couldn't understand how I was getting to decisions so quickly. And I had left them behind. And I ultimately was not being clear about overall strategy. And so I would say that one of the things that I learned is that if you are a solo operator or small, you can go pretty fast. And you can go fast within a big company if you purposefully and strategically say, we are going to remove layers of approvals here. We
Yeah.
are going to have a small working unit that has a lot of autonomy and power and resources to achieve a certain outcome by a certain date. And that's so fun. It's so fun. I always want to. Once you start to get to be a bigger business, and you have multiple stakeholders, moreover, you have hired leaders who are really best in class. You have to go slower
Mm.
because you need to let them do their jobs that you have hired them to do that they are way smarter than you about and way better. Um, and so, they say feedback is a gift, and that was definitely a piece of feedback I got. And in the future, I'll want a balance of fast and slow.
And then let's just talk about building large consumer and retail businesses. And I think this is something that we talked about during our previous conversation, which is that US retail businesses have gone bankrupt at an increasing rate in the last 5 years. I recently read that the parent company of Ann Taylor, Bed Bath Beyond, etc., faced bankruptcy. So, what do you think is happening? Why are they going bankrupt?
So I think with both of those specific cases, they had a lot of stores, and the footprints of those individual stores were quite large. So
Mm,
they had a lot of leases.
mm,
And I imagine that they probably got sideways on some debt, right? They had declining performance because of a lack of merchandise relevancy, competition from Amazon, especially in the case of Bed Bath and Beyond. Um, and they weren't able to get out of those leases in a way that was profitable. If they were
mm.
getting out of leases, they were probably paying large penalties.
Right.
And they probably could service their debt. I have not done like a big deep dive into Ann Taylor and Bed Bath and Beyond, but I bet it's a combination of those things. And I think the question is if Ann Taylor and Bed Bath and Beyond had had the best merchandise. They'd been super relevant, which I don't think either of them maintained relevancy well. And I think that's hugely important for consumer brands is to be relevant, whatever that means at any given point in time. But let's say they had, would they have been able to overcome their retail footprints? I think it still might have been problematic.
And actually read somewhere that you were very focused on numbers and data. And I also know that Eloqui had a small retail presence as well. So, what are the top three things that you definitely tracked? Because we've had a bunch of consumer and retail founders on the podcast, but we are still struggling to answer, okay, what are the top three?
I'm
Um,
curious to hear what they said. But my top three are pretty like brick to head obvious. So I am looking at uh, revenue growth year over year. I think the first thing to say is that in our type of business and apparel business, they're hugely seasonal, hugely.
yeah,
So month over month revenue really means not a lot, unless it's like year one, year two of the business, and you're just
yeah,
in huge growth.
yeah.
I'm looking at year over year, quarter over quarter, month over month, um, of net revenue growth. I am looking at people define it in different ways, but I'm looking at gross or contribution margin growth year over year, quarter over quarter, month over month,
Right.
as well as GMROI, so gross margin return on inventory.
How do you calculate that?
So it's essentially how many gross margin dollars are you getting for every dollar you spend on inventory? So
Okay.
how profitable and how much utility are you getting from your inventory? It has to be greater than one, right?
Okay.
Less than one means that you are not, you're spending more in your inventory than the gross margin dollars you're extracting from it.
Okay.
And you can measure GMROI on different departments, right? So do we see that, like for us, our dresses were quite profitable. So we really, really tried to build a very strong dress business. And most of the time, dresses were 50% of our revenue
Hmm.
because we could really extract more gross margin dollars from them, even though they were higher returned.
Yeah.
And then lastly, I'm looking at EBITDA year over
Yeah.
year, quarter over quarter, month over month. I think you can, and we certainly did look at, I think venture capitalists really want to look at CAC LTV
Yeah.
ratios. And I think that that is certainly viable to look at your marketing efficiency and the projected health of your existing customer base. That said, I think that CAC LTV ratios are really a snapshot in time
Yeah.
and can be quite transitory. Like your customer acquisition cost and your LTV are really based on what does your merchandise assortment look
Right.
like and how is it priced and how is it stocked at the time of measurement. You take those prices up, you can see your LTV plummet and your CAC skyrocket. If you're out of stock on things that customers really want, same.
Yeah.
So I think that it's oftentimes it's used in a more absolute fashion than it should be. Whereas to me, I look at it and it's very, very, very transitory, especially for the type of apparel, the type of business ELOQUII was, which was we launched 3 to 4 new collections a month. We
Hmm.
were performing based on the collection plus our steady state franchises of pants and tunics, et cetera, et cetera. But if we had a collection that did not hit, that CAC LTV was going to look really bad.
Right.
And you can mayonnaise it out, right? Like you can take quarter snapshots, year-long snapshots, right? And you can get a better view. But I think that it's sometimes over relied upon, where you can really get, I think, a similar read looking at contribution margin and EBITDA.
I was actually reading somewhere that Birkenstock does not launch very frequently.
Mm.
And it's playing the LVMH or luxury brand strategy, right? And so are some of the other footwear brands. So, how do you decide a good balance between what your data is showing you versus the kind of brand that you may want the customers to perceive you as?
Well, I think if you look, so Birkenstock's amazing, right? They've done an
Right,
unbelievable job.
right.
And I would put Birkenstock in the category of um, that is a sort of like mono merchant brand in the sense that if, I used to work for David Yurman. David Yurman built a whole business out of one concept, which was cable,
Yeah,
this cable bracelet. Birkenstock has built a business out of this one concept. Same thing with, I mean, LVMH is not the right example, but there are businesses that really become known for, actually, I think you could say LVMH, which is their leather goods, right? And that logo, that they've then done an incredible job of building on from. But those sorts of businesses are saying decidedly, we are not trend. We are not going to follow trends. We have this one item or this one look, like Burberry, this one signature that we are going to merchandise around until our eyes fall out.
yeah,
And we're going to be very smart about monetizing this one signature to the nth degree and building from that. And we're going to use it for licensing. You look at a Burberry bottle of perfume, it's got the plaid around it. Whereas ELOQUII was decidedly a trend business. We
mm,
were saying that this customer, and we heard this over and you talk about listening to customers over and over and over again, that our customers had no newness.
yeah,
Whereas, a smaller size customer had newness all the time. this customer was dying for trend. And so we said, okay, if we're going to do that, then we have to actually give a lot of newness on a regular basis. So if that's true, then how do we help, mitigate our downside risk by swimming, like by having an ever expanding style count or swimming in inventory? So it was our first principle is give her new.
Hmm.
And when you do that, the like confinements or sort of the imposition of order is that we cannot grow our style count.
Yeah.
And so we had to do it within a year over year, like basically static style count, which means that each individual style needs to generate more revenue. So each style has to get better year over year. I think maybe we had like a 5% ability to increase our styles, like 5%, unless we were launching something new like swim or wedding, which we consider to be purely incremental, we would increase our styles for that. So we were very, very scared of runaway style count by having so much newness.
What is interesting is that you went after a single target customer at ELOQUII, which is professional women who live in urban cities. Is that correct?
Well, we didn't go after a specific customer.
Right.
We had a hypothesis that 67% of women in the United States were not being fully served by the apparel market. And we believed what was missing was fashion with a capital F and trend.
Hmm.
And we put that out. And the customer who happened to respond and continue to respond was an educated urban customer. So we got those initial customers where the data looked quite good. We used lookalike modeling and we got more of them. And they were marginally usually the most efficient next customer to acquire. So it's a little like chicken and egg, but I would say that our merchandise assortment and marketing came first, and that's what it happened to end up attracting
Hmm.
versus sort
So,
of like a suburban, stay-at-home mom.
yeah. So, what do you think about building a consumer brand for a specific target group versus a diversified one?
I think that if you have really tested that target market, and you know that there is the legendary product market fit, go for it. Go for it. I wouldn't do that without testing.
Right.
I would, whatever, unless that specific customer group is the hypothesis.
Right.
For us, the merchandise blind spot was the hypothesis.
Hmm.
Um, and so I think you're sort of like going after, um, are you a merchandise first business or are you going after a target market? I would always be a merchandise first business.
Hmm. When you say tested, what is the time duration that you would look at?
30, 60, 90 days.
30,
30,
60.
minimum 30. I think you can do 30, 60.
Okay. Okay.
Yeah, because you want to have a chance for whether you're testing with actual product, you want to get enough feedback, you want to see what a mock return rate might look like. Certainly you want to try different things in different marketing channels and understand who's responding to what and why. And you want to talk to customers. Again, that thing, like you get out in the market and literally sit with them and be like, what did you think of the product? Why? Like, would you recommend it? Why? Why not? How was the price? I mean, don't ask how the price was. They'll always tell you it should.
How often do women buy clothes
Oh my gosh,
in the United States?
that's such a good question. I think it's the straight size customer is like 6 times a year. I think I have to, these are old stats. I have not looked in a
Right.
while.
Yeah.
And then the plus size customer was like 2 to 3.
So much for a lack of enough options.
We were trying to increase the
Yeah.
frequency with
Yeah.
which she bought clothing. Yeah.
Yeah. Interesting. Because I was gonna ask that maybe that fed into your testing timeline as well. The 30, 60, 90. 90
Yeah.
was probably like a great number.
Would you get a repeat?
Yeah.
I think though, so you can get a little like I think not like one can get a little precious with with testing, and
Right.
ultimately, I would sort of say if it looks good enough, go because you're
Yeah.
going to tweak it. You're going to, you're at that point, you're like, if you know you've got a little bit of product market fit, just go for it.
I was actually speaking with a founder, a consumer brand founder, and he's actually from India and he's planning to raise in the US because he wants to launch in the US. There's something he saw in the women in the US and he thinks that his idea would fit perfectly well. But
Awesome.
he's like, I'm so scared. And I asked him, okay, why? He said that nobody's like, it's so hard to raise funds for a consumer brand today. And I asked him, okay, why? He said that many investors are concerned about the CAC, right?
Mhm.
And in that situation, I asked him, okay, what do you think about the brand? Maybe the brand could work wonders. Maybe you can work with the community to reduce your CAC. You can focus on community building. What are the different ways that you can make sure that your brand or your company is actually attractive to venture capital investors, if that is the right way to think about it. So,
I
what
would
do
not.
you think?
I do not think you should be raising early funds for a consumer business from venture capital.
Mm,
I don't think it's, and I think most VCs would actually agree with me. I think,
right,
early stage software or AI business,
right,
great, all day long. But consumer businesses are non-linear. They are not recurring revenue.
right.
There is inventory that in the early days cannot be financed because you don't have enough data. And this is not where venture capitalists, I don't know that they have the patience for it, nor they haven't seen the outcomes, right? So there were a
Okay.
lot of venture capitalists who invested in the 2010s, especially the early 2010s, who have seen either poor or no returns on these D2C investments. And I think as an asset class, they have reallocated those dollars to more profitable, what they see as more profitable investment opportunities. I think you still see a really healthy cohort of investors at the growth equity stage for consumer. But if I were giving advice to your friend, I would say raise as much money as possible from angels. There are still
Mm.
some very, very early stage funds that will do consumer. There are not a lot of them, and they're really special people, in my opinion. Um, I would always say friends and family and angels for the first couple, if you can do it for the first couple of raises.
Is New
And
York?
how to keep CAC low, like
Yeah.
let me know. You're fighting Amazon, you're fighting algorithm changes. You've really got to be a Houdini. And the thing that I hear over and over and over again is people thinking about all of their different marketing channels. And I would just always advise people to go back to their product and their price.
If I am a founder who wants to build the next LVMH, or okay, maybe it's a luxury brand, but let's not go to luxury or
Yeah.
no luxury. But LVMH or Nike, I'm say Bernard Arnault or Phil Knight.
Yeah.
What should I spend my time on?
Merchandise, 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 merchandise,
Hmm.
merchandise. Right. First things first.
Yeah.
If you don't have, they have built, Nike and LVMH have built like the brands to end all brands, right? They mean so much to so many people in both explicit and implicit ways. When you wear one of those brands, it confers
Love
so,
that.
right? It confers so much import to your tribe, whatever your tribe might be. But their brands wouldn't mean anything if they did not have superior merchandise.
Yeah.
And you see, especially with the case of Nike, but it's also true with LVMH, you see brands like Hoka and On, and wait, there's another one, but those two, like they have made great products that have differentiation. they're being taken seriously. Like those are real contenders. So Vuori just raised, I think it's around $500,000 from
Wow.
General Atlantic at a multi-billion dollar valuation.
Right.
They're competing with Lululemon, right? So, but what did everyone get excited about with Vuori? The merchandise, the product.
Yeah.
You know, with politics, James Carville says it's the economy, stupid. And I think with a consumer business, it's the product, stupid. You know, like that's, I wouldn't say stupid, but it's the product. Like that is the right product, a great product at the right price. You have so much to work with. The one thing that I would add is that I think for brands that can find something that is uh, you can copyright it, or you can, whether there's a fabric that you can have some sort of IP, you're not really going to be able to patent it, but that there's something proprietary. That's always interesting from a both offense and defensive
Hmm.
perspective.
I agree. And then the other thing, which is, I mean, you said that everyone wants to feel a part of a tribe, whatever the tribe may be. I was actually just discussing this with my husband yesterday that you know, you remember the times when we used to have these large logos printed on our jackets or wherever, right? And then there came a time where there were no logos, and now there is a talk of, having small logos, right? But still having logos because people want to feel great about wearing a brand. My husband said that he loves Ralph Lauren logos because they are so tiny, but they're
Mhm.
still there. So it's really evolving, and you also mentioned that you have to be relevant and you have to be dynamic because the consumer is very dynamic and it changes so frequently,
So fast.
including, something that you may consider a very small aspect, but it's a big aspect if you think about it, the logo, because it
Yeah.
just defines you.
Yeah, and not having a logo is just as tribal as having a logo.
Yeah. Oh, that's a very good point because
Right. The whole idea of quiet luxury and like the rich mom energy and all
right.
that sort of stuff, like Succession,
Yeah.
Loro Piano, Brunello Cucinelli, et cetera, The Row, Kate, they are completely no logo. And that's the whole point.
How
Mhm.
big is the row actually?
I don't know, but they did just sell a minority, I believe, a minority stake. I would bet it's close to 100, but I have absolutely no idea. I'm saying that at like no clue, 5 o'clock on a Friday afternoon.
Growing up, my cousin and I were big fans of Ashley and Mary-Kate Olsen, and we were like just 6 months apart in India. Can you
Oh,
imagine in a very small
oh,
town in India?
that's
Because
really
we
amazing.
because we watched New York Minute, and then we somehow convinced our grandfather to send us to New York so that we could watch the Simple Plan concert because that's what was featured on New
Oh,
York Minute.
that's so sweet. That is really sweet. Did it live up to your dream?
Yeah, absolutely. Thank you so much for taking the time, Mariah. It was lovely chatting with you
It
and
was
getting to
great to
know
chat with you too.
so much about your journey. Thanks.